Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letters CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Hello, and welcome to another episode of Reverse Mortgage Radio. Very glad you could join me today for the first radio show that I'm doing anyway in August of 2024. What we're going to do today is kind of a hodgepodge because I've got a few different things I want to talk about. I definitely want to talk about interest rates. They're coming down, right? But the Federal Reserve has not lowered rates. So what's the deal with that? We're going to talk about what it all means, and we're also going to talk about expectations. What happens if the Fed does not lower rates next month? We're going to talk about all that. That's the meat and potatoes of the show. But I think that we've got some side dishes as well, if we've got time. I'm going to dig into the interest rates quite a bit. But we're going to talk about a recent study that came out about Social Security benefits not keeping up with inflation. Who would have thunk it, right? Like you didn't know. But now there's some proof, and we're going to talk about that. Also, if there's time, I was stumbling around on the interweb here, and I found at the National Council on Aging, they've got a very good site. And I've been there before, but just so you know, the National Council on Aging.org, they've got some great resources on there about how older adults can get some help with housing costs. And I figured, well, this is a show about housing, right? So we're going to talk about that as well. Hopefully, if there's enough time, if I don't get too long-winded on these other topics. But you know how to reach me, probably. If you don't, my name is Bruce Simmons. I'm the reverse mortgage manager with American Liberty Mortgage here in Denver. American Liberty Mortgage Incorporated is the official name of the company. And we're in Denver. You can reach me directly on my phone at 303-467-7821. 303-467-7821. That is not my cell. Do not text me there. If you do, I will not get it. Okay? Call me, talk to me, and I'll give you my cell number. I just don't like putting the cell number out on the radio. Well, it's on my website too. My website is reversemortgageradio.net. Reversemortgageradio.net is my website. And next week, this show will be posted on my website, and it'll be on other outlets as well, Spotify, I think. And I'm still dealing with iHeart. My Apple passwords just don't work. I don't know what's going on with that stuff. I'm not very technologically savvy. And my web guy's trying to get me up to speed, but it's a fight to the death, I swear. So keep that in mind. Definitely go to my website. You can download my consumer guide. It's my Colorado Reverse Mortgage Consumer Guide on the website as well. And it's got a ton of great information all about reverse mortgages. Let's start talking about interest rates, because I've had a couple customers that I've already got applications going with today called me, and they're like, hey, the rates are coming down. Is that going to help me out? And my answer is yes. However, they could bounce back up tomorrow, right? If somebody comes out from the Federal Reserve next week and they say they put a little damper on the possibility of raising or lowering interest rates in September, that could start the reversal of interest rates. See, the way the interest rates work generally, this is a general thing. Interest rates are typically based on the 10-year bond, or with reverse mortgage, it's a 10-year Treasury index. That's called the CMT, which is the Constant Maturity Treasury. CMT. So you can Google this. Go to the U.S. 10-year Treasury index. And you'll find a website. And I don't remember what the site is. I should have looked it up exactly. But I've got an app on my phone now, so I don't have to go onto the website to see. But every day, interest rates are posted for the 1 month, 2 month, 3 months, 6 month, 1 year, on all the way up to 30-year bond rates. The bonds are rates that the government pays to people to loan them money. You want to get a 10-year U.S. Treasury rate, or U.S. Treasury bond, then yes, that's going to cost you roughly 4.25%. Although as of earlier last week, and like Thursday, I think it was 3.96. That's what the interest rate was paying. So if you loan the government money for 10 years, they're going to pay you 3.96. Now, 1 year, they're going to pay you 4.67. So the rates are dropping, because I know I've still got a couple of time deposits. They don't call them CDs anymore, but time deposits at 5.25. Because I did them for 6 months and actually even 90 days, and got one that paid an APR of 4.25, or APY, I mean. And so that's the rate that the government is paying people to loan them money. And now what's happening is those interest rates are coming down. So if you loan the government money now on 10 years today, you're only going to get 3.96. Whereas back, say, in April, you could have got 4.75 on the 10-year Treasury. Or on the 1-year Treasury, you could have got 5.25 back in April if you'd taken out a Treasury, in a 1-year Treasury index back then. So that kind of explains how that works. But now, why are they dropping? The Federal Reserve has not lowered rates. That's a key thing. It's all based on expectations. Earlier last week, the Federal Reserve came out and made some comments about how they're getting a little more dovish, less hawkish. The hawks and the doves are battling it out. Basically, they're saying that the likelihood of an interest rate cut in September is growing. And there's even odds. You could place a bet on whether or not the rates come down. I don't know what the odds are now. It was back before this last week, it was 50-50. And I was more pessimistic about it. I didn't think the rates were going to come down in April, or in September. But who knows? I may be wrong. I hope I am. I really hope I am. But what happens then is that, in combination with some economic news like, unemployment is starting to go up. So that's good news for interest rates, because it's more likely that the Federal Reserve is going to cut. And if inflation is coming down, well, that's good for the economy, of course. And that means that the inflation is coming under control. So the Federal Reserve could cut without hurting inflation. Hopefully, we'll see. So all of these things are expectations. That's why in 1 week, just 1 week, the interest rates have dropped 0.25 point on the 10-year U.S. Treasury index. Friday, the 26th, the interest rate on a 10-year Treasury index was 4.24. Now, that's not the rate you're charged. I follow the 10-year Treasury index because we, as an industry in the reverse mortgage industry, we use that index to tell us how much money we can loan you. We use that interest rate, because it tells us the amount that we can loan. We use the 1-year Treasury index. That's the rate you're actually charged on any money you borrow on the loan. But then we also add something called a margin to it. Typically, it's 2.5%. So, for example, last week, the rate for the 1-year Treasury, this is the interest you would be charged if you took out a loan, you closed on the reverse mortgage. The interest rate was 4.9% that was as of July 23rd. Okay, 4.90. Then we add 2.5 to it, so that would take us to like 7.4%. That would be the interest rate you're charged. However, as of like Thursday, I didn't check Fridays, but Thursday rate it was 4.67. And we add 2.25 to that. That takes us to 4.92, I think, if my math is correct. So you could see, 6.92, not 4. But you can see how that can change. I mean, it changed very quickly. It came down. Now, strange as it seems, let's say September rolls around. These rates kind of stay where they're at. And then September comes around and the Fed does not cut interest rates. They keep them steady. They're not increasing, but they're not going to decrease. Well, everybody thinks that the rates are going to be decreased, so that rate has been built in to the index already. So we've already, before the Fed lowered the rate, we've already given you credit or charging less money, okay, on these interest rates. So if the Fed does not do the cut, even though they don't raise it, interest rates could spike back up real quick. And they would probably go more than 0.25% up, unfortunately. It's kind of a weird thing. Just be aware, because I know every time the Federal Reserve makes a move up or down, I get calls. Hey, how does this affect me? Well, it doesn't at this point because the rates have already been baked in. Okay? Keep that in mind. Now, what does it mean? What's the difference between 0.25% interest rate on the amount of money we can loan you? Again, remember, with reverse mortgages, there's two different interest rates. There's what's called the initial rate. That's the rate you're actually charged on any money you borrow. And that is based on the 1-year Treasury index plus the margin. Then there's something called the expected rate, which is the rate we use to calculate how much we can loan you. And that is based on the 10-year Treasury index plus that margin. So just as an example, in the last week, rates dropped 0.25 point. What does that mean for the 70-year-old person who owns a $500,000 home? Well, we can loan $190,500 as of last week. Right? Actually, the way the rates work, this week, the interest rates are based on last week's rates. So we take last week's rates plus the margin, and they're effective for this entire week. And then next week, the interest rates that we're charging people are based on the rates for this week. So they're dropping 0.25 point. And that's kind of how that works. It's kind of weird. But anyways, keep that in mind that the rates actually run a little bit in arrears on that. But the difference for somebody that's 70 years old, that person with a $500,000 home could get $190,500. That's 38.1%. Now, based on if the interest rates drop 0.25%, we could loan $196,000, $5,500 difference. That's basically 1.1% more money. So we could loan 39.2% instead of 38.1%. So in other words, you think interest rates do make a difference, but they're not going to be a gigantic difference. People will call me, I may have talked to earlier in the year, and they were $50,000 short to close. So in other words, let's say they had a mortgage of $250,000, and I'm telling them I can only loan them $200,000. Now the interest rates drop 0.25, and they call me and say, "Hey, can I qualify now?" Well, instead of it dropping by $50,000, or increasing the amount we could loan you by $50,000, it only increased the amount we could loan by $5,500. So no, it has to be. You have to be very, very close. If you're on the cusp of us being able to loan you just enough money to pay off your mortgage, then this can help you. It can be a huge benefit because now you could refinance, or you can get a new reverse mortgage, pay off your old mortgage, and might save you $800, $900, $1,000 a month in principal and interest payments. Now, you're still responsible to pay your own taxes and insurance with a reverse mortgage. You have to live in the home, keep your name on title, and maintain it as well. But no mortgage payment is required to the lender, no principal and interest mortgage payment. So you got to keep all this in perspective. If you hear about the interest rates coming down, it's great news. It's hopefully a trend that we're setting, because it can lead to more and more and more rate cuts, which will mean the interest rate will come lower and lower. However, just keep in mind, even if the rates drop a full percent, let's say by the middle of next year, if the Federal Reserve has lowered them by a full percent, we can now, for that same person who's 70 years old on a $500,000 home, we can loan $213,500. So it's increased the amount we can loan to this person by $23,000, which it's about a 4.5% difference in loan to value. So we're, instead of loaning 38.1%, we're loaning 42.7%. So you can see, in order to get back to the heyday of 2021, 2021, 2022 timeframe, the rates have to drop by at least 2 or 2.5% from where they are now. And by the rate, I mean the 10-year Treasury Index, because that's the one we use to calculate how much we can loan you. Just keep everything in perspective. Do not, though, hesitate to give me a call with any questions. My name is Bruce Simmons. I'm the Reverse Mortgage Manager with American Liberty Mortgage, and you're listening to Reverse Mortgage Radio. You can reach me directly at 303-467-7821. 303-467-7821 is my direct line. You can also visit me online at reversemortgageradio.net. reversemortgageradio.net. This whole show will be posted on my website next week, and you can also download my consumer guide. It's a free resource for you that explains pretty much A to Z and all the nuts and bolts of reverse mortgages, probably more than you want to know, actually. It's a lot of information. Skim through it, make notes, call me with questions. That's what I tell people to do. And I'd be very, very happy to run numbers for your specific situation, let you know if we can help you and how much we're able to loan and what the interest rates are, closing costs, all that good stuff. So that's the meat and potatoes of the show right there. Now let's get into the side dishes. The number one side dish I want to talk about here is Social Security benefits have lost. Take a guess. How much do you think they've lost in the last 15 years of purchasing power? 20%. You've lost 20% of your purchasing power in the last 15 years if you're on Social Security. That's crazy, because they're supposed to keep up with inflation, right? COLA, cost of living adjustments, right? No, that's not the way it works. There's a study by the Senior Citizens League, which is a nonpartisan group that monitors and advocates for senior benefits such as Social Security and Medicare. But they found Social Security benefits have lost 20% of their purchasing power since 2010, despite all the COLAs, the cost of living adjustments. The underlying cause of the cost of living adjustments is the cost of living adjustments lagging behind inflation in 8 of the last 15 years. In only 2023, the cost of living adjustment exceeded inflation when, we remember, Social Security recipients received an 8.7% boost in payments. And as inflation drops, then this year, your bump next year is going to go down as well. To illustrate the point, okay, the Senior Citizen League gives the example. Imagine that you're retired with a monthly benefit of $1,000 in 2009. The next year, 2010, you get a COLA, the cost of living adjustment of, remember this one? 0.00%. But inflation was 2.7%. Now your payment's still $1,000, but you would need $1,027 for it to be worth the same as it was the year before. Then in 2011, it happened again. You got a cost of living adjustment of 0.0% compared to inflation of 1.5%. suddenly your payment, which is still $1,000, you'd need $1,042 to maintain the same worth as when you retired. And even later in the years, I remember seeing people's, they would get a 1.5% bump in their COLA, but then it would all be gone with Medicare. Medicare would take 100% of their bump. I'm like, holy cow, is that crazy or what? And it was year after year for a long time. But that's what happened. They found the what would they call the Senior Citizens League found that from 2010 to 2024, transportation costs increased by 96%. Now I'm assuming that's probably a combination of fuel, cost of bus passes, maybe trains, cars going up a lot, the cost of vehicles, all that. I assume that's all in there. They don't break it down in this article that I have. Communication went up by 92%. Is that cell phones? And how much cell phones cost? I don't know. Housing went up by 81%. And food by 56%. Medical services by 50%. So you can see those costs are going out of control. But your Social Security is chugging along and you're just losing ground every year. Boom, 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 boom. Now, if you're tired of that and you've got a lot of equity in your home and you're in a home you want to stay in, please give me a call. My name is Bruce Simmons. You can reach me directly at 303-467-7821. 303-467-7821. I've been specializing in reverse mortgages since 2001. 2003. 21 years is how long I've been doing reverse mortgages, since 2003. And it's the only loan I do. I don't mess around with VA loans or conventional loans or other FHA loans. I only do reverse mortgages. I'm a certified reverse mortgage professional, and we are a member of the National Reverse Mortgage Lenders Association, which holds us, and especially CRMPs, certified reverse mortgage professionals. We get held to a higher standard than your traditional loan officer who might close 1 or 2 or 3 reverse mortgages in a year. So keep that in mind. Now, real quick, I do want to touch on some help that you can get for paying for housing, because as we know, I mean, this can help out renters and homeowners. But go to the National Council on Aging. It's the website is NCOA. Let's see what it's NCOA.org, and then you can go to /article. Okay, and that'll take you to this article that says how older adults can get help paying for housing. And what it does is it goes through some different things. It talks about some of the crazy statistics on housing. So housing costs represent roughly 25% of expenses for all Americans age 65 plus. But in 2021, 11.2 million older homeowners were housing costs burdened. That means that we're spending over 30% of their income on housing. Basically, more than 17 million Americans are economically insecure, and a huge part of that is housing. They have here older adults who require long-term care services face an even greater cost burden. In 2022, fewer than 15% of those age 75 plus could afford both housing and long-term care services. And then too, the same thing with people who are in just poor health. Seniors living in lower quality housing are at an increased risk for falls and more likely to enter nursing homes too. Keep all that stuff in mind. I mean, it's a sad situation. But basically, they have here that housing costs represent the greatest expense for people age 55 and older and all that stuff. So we're going to talk, though, if you're having some challenges with your rent or mortgage, you can go to the HOPE hotline, HOPE hotline. And again, the website for this is ncoa.org. And it's /article, and it'll take you to this article on how older adults can get help paying for housing. If you just Google that, you'll find it, and I'm sure it'll come up. But the Hope Hotline is 1-888-995-HOPE, which is 1-888-995-4673. That spells HOPE. Okay, so you can go there. They offer free renter counseling and education to support people in addressing their housing concerns. And they have, they say the Hope Hotline does not directly administer rental assistance programs or offer financial support, but they can direct you to places that can help you. And then Consumer Finance Protection Bureau, too. You can get housing vouchers. So they have here public housing vouchers provide eligible low-cost or low-income families, including older adults and adults with disabilities, to get housing vouchers. Sometimes they're referred to Section 8. And this doesn't apply to homeowners, but you can get help for paying for your rent. They also question the point here, should you tap into your home equity with either a home equity line of credit or a reverse mortgage? They talk, and they give correct facts on reverse mortgages at the National Council on Aging. They actually have a handout that I give to everybody that's interested in a reverse mortgage as well, about reverse mortgages. They helped kind of push the program along back in 1988 when it was signed by Ronald Reagan. Did you know that reverse mortgages have been around since 1988 as an FHA insured loan? They've been around longer than that, but as an FHA insured loan since 1988. The first loan, the first FHA reverse mortgage, was closed in 1989 after Ronald Reagan signed the bill in 1988. And let's see, they talk about a number of different things in this article that, let's see, they say here, if you struggle finding affordable housing, you may want to explore other benefits that can free up income. And they talk about things that can free up income in here too, about, like, for example, if you own a residence with a spare bedroom or unit, such as a basement apartment, you might consider renting through a home share arrangement. And they've got contacts here on how to do that safely and check for landlord, check for, do background checks and things like that, making sure you're getting somebody that's legitimate who's coming into your home. I highly recommend that article. It's very informative if you're struggling with housing costs. Hopefully you're not, but if you are too, you can also call me if you own a home with a lot of equity in it. I appreciate you listening to the show today. My name is Bruce Simmons. You can reach me at 303-467-7821. I'm the reverse mortgage manager for American Liberty Mortgage Incorporated. We're headquartered right here in Denver, Colorado. 303-467-7821. That's my direct line. It'll ring right to me. I've got it forwarded to my cell phone, actually. But you can also visit me online at reversemortgageradio.net. reversemortgageradio.net. I've got a very thorough consumer guide on there about reverse mortgages, and you can also listen to the podcast. Next week, the podcast of this show will be on my website. Thank you so much for joining me today, and I hope you have a safe, cool afternoon. Thank you.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821 or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.